Hello again. Welcome to another episode of the Uranium Market Minute. Today is Thursday, April 14th, and this is episode number 106. My name is Justin Huhn. I am your host. I'm the founder and publisher of the Uranium Insider Pro Newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. As always, nothing in this video is intended to be investing advice, not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing, and always take responsibility for your own choices. All right, this is going to be a pretty quick episode. Not really a whole lot to report on today. We were going into a long weekend. The markets are closed tomorrow for Good Friday. Looks like investors are taking some money off the table, not necessarily in the uranium markets, but the broad market down over 1% today. Close looks like it's about to close at its lows. So, investors not wanting to be too long going into a 3-day weekend where so much can happen in a single day. Give 3 days of the market closed, and there's some risk added to the Monday open. So we've seen this actually very frequently in the broad markets on Fridays, or in this case, at the end of the week, since January, really, since we've been in more of a risk-off environment for the broad markets, just some investors taking risk off the table at the end of the week. Want to remind everybody again that this coming Monday, April 18th, we'll be having our members only webinar. If you are a member of Uranium Insider Pro, look out for a bulletin that we'll be sending out later today or earlier today, depending on when I publish this, that will highlight the directions to join that webinar. And again, we will send out the login credentials for that webinar 1 hour before the webinar starts on Monday morning. That's morning where I'm at in the Pacific time in the United States. Of course, we have people join us around the world. It's always a great time. We do have a very exciting guest to discuss a very exciting new position for the company, and very much looking forward to that. So I hope to see you there. All right, why don't we just go ahead and run through the daily scoreboard and the charts, and I'm going to speak briefly about kind of a 10,000 foot view in the mailbag section. Spot price of uranium is holding tight, sticking there at 63.75 a pound, unchanged from yesterday. Considering Sprott has not been purchasing a whole lot of uranium this week, it's very good to see that the uranium price is holding and is not slipping, despite multiple days in a row of the Spot Trust trading at a discount to NAV for the most part. They did buy 100,000 pounds yesterday, but did not raise any new capital. So now the NAV of that vehicle of SPUT, 3.56 billion, that's an all-time high. This, of course, is before an NYSE listing, which we do expect they will succeed in getting. That is likely to happen in Q3. We are now just a few days into the 21-day period, the comment period for the SEC, for the SPUT vehicle. And the SEC has 45 days from, this is the end of last week, I believe, or earlier this week. So now we probably have about 40 days to make a decision. They can extend that decision time period for another 45 days. So at the very latest, we're talking about third week of July, we should know for sure whether or not SPUT will have that NYSE listing, and we could know much sooner. So that's very exciting. They did actually announce that their US OTC ticker, SRUUF, has been upgraded to the OTC best market. It remains as SRUUF. However, it shall probably have better spreads, better liquidity on this upgraded exchange on the OTC. Year to date, SPUT has purchased 13.6 million pounds. They've raised almost $750 million in new capital. And that's just over, 3 weeks. What do we got? We got 13, 14 weeks into the year. Just a phenomenal amount of buying on the behalf of SPUT. They closed at almost a 3% discount to NAV yesterday, and the trust did dip again today with a spot price flat. They're likely about to close at closer to a 5% premium or discount to NAV, excuse me. So this is the greatest discount to NAV that we've seen over the past, let's say, 3 or 4 weeks since we've been in this uptrend. Uptrend really has been more around 7 or 8 weeks, but we've been mostly at a premium to NAV for the most part. But the past week, they've been mostly at a discount to NAV. So the sector cooling off a little bit here to end the week. They're sitting on 59 million in cash. The ETFs. So URA reported another 1-day increase. This reporting was of 310,000 shares increase in their shares outstanding. URNM reported 200,000 shares outstanding. That led to 24.7 million in mandated buying. I'm going to talk a bit more about these flows, these ETF flows, and the flywheel effect in the mailbag section. The uranium equities actually held up relatively well today. Usually when we have a day where the S&P is selling off, it actually sold off pretty strongly in the late morning. And we saw some dip buying in the middle of the day on the S&P, but still it's looking like it's close to closing at its lows of the day. Usually with trading action like that in the broad markets, before we've, mostly decoupled from the broad markets over the past few months, that the uranium stocks would get hit. And we actually traded very, very strongly today for the most part with that considered. So why don't we take a look at the charts? URA down just over 1% on the day. I'm curious to see where the S&P ended. We've got a couple of minutes left, almost 1.2% down on the day, with closing at the lows, pretty nasty. So let's go back to URA. URA is looking relatively strong. Not much change from yesterday, down about 1%. Volume, average volume, moving average is still pointing at a 45-degree angle up. It's beautiful to see. Indicators are strong, looking like they have some room to run, not super overbought, still room to run here, but definitely all in all, overall, a very bullish chart. I kind of want to look at the weekly chart here as we end the trading week. Pretty good chart for the week. Ended up almost 2% on the week for URA. Volume decreasing over the past month, but still in an uptrend in terms of volume overall from the previous leg higher, which we saw, last summer into early last fall. Very beautiful chart. I love looking at this chart, especially zooming out on the URA chart. Broad Physical Uranium Trust on the week actually down 3.75% on the week. And let's take a look at the daily chart for the SPUT Trust. Down 1.5% on the day. Dip buying showed up exactly at the 20-day moving average, which has been support, I would say, over the past about 6 weeks. We did break through that intraday in the third week of March, but for the most part, that 20-day has seen support. Will we see further selling in this name? I'm not sure, but we're definitely seeing a decoupling of the miners relative to SPUT. Now, this is a chart that I highlighted to our members last week. So considering that they have seen this already, I will go ahead and bring this up and show this to you just to show that outperformance of the equities relative to SPUT. Now, why don't we look at the weekly chart of this? Now, this is essentially the equities trading compared to the metal. Now, this doesn't really give you a long-term fair perspective because this starts at the inception of URNM, which was December 2019. Of course, that trust generally grew for quite a while, this ETF. However, relative to the metal, we highlighted this positive divergence in the RSI for this chart. And I believe that we are now 1 week into, possibly even 2 weeks into a bottom for the equities. Now, I did highlight this last week. I wanted to make sure we held that low of the previous week in terms of the equities performance relative to SPUT. And SPUT is the spot price, essentially. They're close enough to NAV, consistently enough to basically say that SPUT is the spot price. Now we're seeing a nice bullish cross, a golden cross here of on the MACD. And we are seeing the RSI positive divergence stick. Now, what is positive divergence on the RSI? When you see the equity make a lower low, and in this case, this is not the equity, this is a relative chart. But when you see the price action on the chart make a lower low and RSI make a higher low, that's positive divergence. And of course, it works in the opposite direction. When the stock makes a higher high and RSI makes a lower high, that's negative divergence. We saw a lot of that back in November. So this is a very, very good looking chart. And I think we have a long ways to go for the equities relative to SPUT. And of course, I consider that the spot price is likely to continue rising. Cameco has been a sector leader, has been absolutely just up on stilts. We can see, though, that we're running out of steam a little bit here. Look, about 6 weeks of declining volume on the weekly chart while we still climb in the price of the equity. Overall, I think that Cameco has some room to run, but might need to take a breather here. So I wouldn't be surprised to see a little bit of consolidation across the sector, especially in these outperforming equities. All right, so in the mailbag section, I did have a question come into me asking about ETF flows, just generally speaking. So I thought I would talk about that in terms of the importance of flows in this market. especially compared to valuation arguments. There's a number of metrics that uranium investors will use to gauge relative valuation. And one of those metrics is enterprise value relative to the pounds in the ground. And this is not a very accurate measurement, but it is an accurate way, or not an accurate way, but it is a relative way to look at valuations and to compare them from one market to the previous, let's say the previous bull market, from one equity to another. But there's so many other factors like jurisdiction, like the type, total pounds in the ground. A low grade pound is very different from an high grade pound. A pound in Cigar Lake mine is very different from a pound in Namibia. How it can be mined, et cetera, et cetera. That is one method that some investors will utilize to gauge valuation. Another, of course, is for producing companies or from expected to be producing companies. You can do a discounted cash flow model, go out into the future, try to get a grasp of how this company should be valued now. If you do that with potential producers across the uranium space, most of the time you come up with, oh, these things are way overvalued. So that is why, generally speaking, these type of valuation models don't really work for this type of market. It's all about flows. It's all about the flow of funds. Okay, so I wanted to give you a 30,000 foot view here. Flows, flows, flows. 18 months ago, we began educating our subscribers about the flywheel effect. Okay, I've mentioned this many, many times. I mentioned it yesterday on the Uranium Market Minute. I'll mention it again today. Flywheel effect essentially is flows, funds coming into the ETFs buy the underlying holdings, and the whole space moves. Why do the funds come into the ETFs? Well, they have the most liquidity. Liquidity is paramount for institutions. And even though institutions will absolutely position into individual equities, they have a minimal number of options, right? They have SPUT, they've got Cameco, they have NextGen, they have Kazatomprom, maybe a couple of others that are up there into the 1.5 to 2 billion market cap. Got the Paladins, the UECs, stocks like that. But for the most part, they seek out liquidity. And so what happens when funds, whether it's from institutions or from retail, come into the ETFs, that creates supportive purchasing action by the ETFs of the sector. We call that the flywheel effect. Of course, that has kind of a doubling effect with SPUT being held by the ETFs. Funds flow into the ETFs buy SPUT buys physical. It just continues and continues. And so we watch that religiously. And we highlighted actually on this podcast back in January. And of course, prior to that, to our members of Uranium Insider Pro. In fact, on the January webinar that we did, the members webinar, we brought this up and we reiterated it in February because the sector still had yet to really move sharply. And what did we see? We saw a sell-off across the sector starting in late November, throughout the month of December, into the month of January, where we started to have a pretty significant risk-off environment in broad markets in January. The uranium equities dropped by anywhere from 30 to 50% from the November highs. What happened during that period from November into late January? The outstanding shares of the ETFs increased. We noted that over and over. These flows really matter. And so what did that mean? That meant to us that there was smart money positioning. There was smart money buying up the shares that retail was selling. Okay. When you have retail reacts and acts in the markets in a very predictable manner. And when you have markets going to risk off, when you have selling going to risk off, either uranium equities going risk off, you have retail, you have basically, let's say 40% of retail is sellers. They follow that momentum. They sell at the lows. That just happens. That's what it does. 40% is just shocked into submission and not moving. They're curled up in the fetal position. They don't want to look at the screen, and they don't sell. They don't buy. They just go, well, this is too much for me. I'm sitting back. And then 10% are contrarians that are buying up shares that the 40% of retail are selling off. And of course, in our opinion, institutions were continuing to position into the ETFs, especially into URA, during December, during January. And we noted that to our members, obviously, firstly, and then, of course, to this podcast as well. Now, why did that matter? When sentiment is extremely low and you might be doubting your thesis, when you can see things like this, then you understand what is going to happen. If you see smart money positioning when the equities are selling off, you can make a relatively accurate prediction that over the next number of months, we are likely to see a reversal. and the smart money will again be right. And this happens over and over and over. So what are we seeing now? The flows continue to come into the sector. Does that mean that next week will be strongly in the green? Not necessarily. Does that mean that next week is the moonshot? Not necessarily. What does it mean? It means that money continues to position in this sector. We're seeing an outperformance of the broad market. We're seeing flows increase, even though we saw volumes decrease throughout the week. The sector's been on a strong run for almost 2 months. So you can expect some consolidation. We expect that this leg is not over and is likely to continue to grow and to move to the north as funds continue to flow in here. So I just wanted to just highlight that and give a sort of a 30,000 foot view about these flows. I mentioned in yesterday's podcast as well that institutions, when they recognize that they have a market under their thumb, that they can be bloodthirsty. Funds can absolutely be bloodthirsty when they recognize an opportunity, and when they recognize, and this opportunity is very unique because the investing sector in uranium, they watch the spot price. That's the most visible element of the fuel cycle that everyone can see for free, and it's updated on a daily basis. All right. Some of the other elements of the fuel cycle are only updated monthly, and some of them it's very difficult to see any further detail on that without paying very large sums of money for subscriptions to the nuclear fuel consultants like UXC or like TradeTech. Now, we do subscribe to these services because we want to get their take on the sector on a weekly and sometimes daily basis, and we do, and that has been very helpful. However, the spot price is what is most visible. It's what the investors and traders and speculators and tourists and everybody that's interested in uranium or invested in uranium watches the spot price. Well, now institutions, hedge funds, large net worth investors have a vehicle that is the most liquid vehicle, or close to the most liquid vehicle in the space. It will be the most liquid vehicle, in my opinion. By the end of this year, SPUT will be the most liquid vehicle in the space. That their money going into that, not only does it follow the commodity, and a lot of large institutions and large high net worth investors prefer to expose themselves to the commodity rather than to the individual equities because they have individual minor risk, jurisdiction, management, et cetera, et cetera, et cetera. So just to expose to the commodity is attractive for a larger institution or a high net worth investor who doesn't want to take unnecessary risks in the space. Now, retail loves risk. Retail goes after the tiny cap stock that's hoping that they hit something during a bull market, an exploration stock. Institutional money does not do that. So they're going to go after SPUT. So what happens? That money buys physical. That buying moves the spot price, and it moves the whole sector. And so we believe that institutions have been and will continue to be positioning into the large caps, into the ETFs, and into SPUT. And that will be a, buying into the SPUT will sort of be a self-fulfilling prophecy in terms of moving the rest of their holdings. So you can buy a basket of equities or the ETFs or Cameco or NextGen, Kazatomprom, whatever it might be. And then you hammer into SPUT and they buy physical and everything moves up. And so it's this beautiful double flywheel effect. And funds are aware of this, and they will be increasingly aware of this. And increased trading volume, increased liquidity, increased market capitalization, NAV of SPUT will only bring in more funds. So from a retail perspective, we can zoom out on these charts and say, oh my gosh, I wish I was buying in 2017, or I wish I was buying in the March crash of 2020. We're already up 15, 20, 25x in some of these names. This must be close to being over. And then you have the actual smart, very wealthy players and funds on the other side that are saying, man, I just can't wait. I can't wait to get into this sector. When is there going to be enough liquidity for me to take a 1% position in SPUT into URA? And so that is kind of yet another flywheel. As the sector grows, that growth begets more growth. And so unless you think that commodities are about to die, inflation is about to reverse, and everything's going to go back to honky-dory, peaceful, normal next week, then I think you should stay long. We are absolutely long here, and we think this run has a lot of legs left in it. And judging by the flows, that is pointing in the direction that that supports that thesis. So I wanted to leave you guys with that. I hope that you have a great long weekend. A lot of us are still working on Fridays, but with the market closed, it should be less intense, at least for me. And hope you have a great long weekend and a great Easter if you celebrate such things. And we will see you again next week. Like I mentioned, next week is going to be a short week for me. I'm going to be out of town Wednesday through Friday on a boots on the ground trip, but I will be here Monday, Tuesday, and Monday morning, our members webinar. We hope to see you there. It's going to be a good time to be had by all. All right. Cheers, everybody. Thank you for watching and have a great weekend.